The RBI governor has just announced the latest monetary policy decision. Interest rates remain unchanged, but most importantly, it announced 4 major measures that will attract foreign money coming into India and support the rupee. Watch the video till the end to understand everything that RBI governor has just told in simple language. Now, RBI will maintain a neutral policy stance. What does that mean? This means RBI is not committing anything with respect to increase or decrease in interest rates in near future. Instead, it wants to remain flexible and take decisions based on incoming economic data. RBI has given fresh signals for inflation, economic growth, health of Indian banks, foreign investment, and the future direction of Indian economy. The repo rate is unchanged at 5.25%. Similarly, other policy rates are also unchanged. SDF rate at 5%, MSF and bank rate at 5.5%. According to RBI governor, the global environment still remains uncertain. There are 3 key risks on the RBI radar. First, geopolitical tensions and conflicts in West Asia. Second, supply chain disruptions that can increase production costs globally. And third, volatile crude oil prices. Despite all these global uncertainties, RBI still is optimistic about Indian economy. It expects GDP growth of 6.6% in FY27, and according to RBI, growth will be supported by strong consumer demand, government infrastructure spending, momentum in the services sector, and healthy credit growth from the banks. RBI is optimistic on growth, but it is cautious on inflation. RBI expects inflation to average around 5.1% in FY27. Governor has highlighted the strength of Indian economy through some numbers which are important to note. Bank credit growth is running at 15.4%. Capital adequacy ratio stands at 17.7%. Gross NPAs have fallen to a record low of 1.73% only. Forex reserves stand at over $682 billion, which gives us the cushion for 11 months to cover imports. These numbers indicate that Indian banks are well capitalized and the financial system is resilient. Now let us discuss the 4 major announcements given by RBI governor on the foreign institutional investors. Number 1, more government bonds opened for foreign investors. The government has expanded FAR, that is fully accessible route, to include more government bonds. Normally foreign investors face limits when they have to invest in government bonds. More investors means higher demand for government bonds and therefore it will have lesser borrowing costs to the government. Announcement number 2, easier investment for FPIs and NRIs. RBI has also relaxed investment limits for foreign portfolio investors and NRIs. This means global funds and Indian investors can easily invest in Indian debt markets. Now, why does this matter? More foreign investment means more capital entering India, better liquidity in financial markets, greater demand for Indian assets, and additional support for the rupee. In simple terms, RBI wants more global money to flow into India. Announcement number 3, extension of concessional Forex swap facilities. This is done for ECBs, that is external commercial borrowings, and FCNR deposits till September 2026. These facilities make it easier and cheaper for banks to access foreign currency. More dollar inflows will mean better forex liquidity, stronger foreign exchange reserves, and reduced pressure on rupee during volatile periods. 4th major announcement was on more flexibility for exporters. Export proceeds realization time has been limited to 9 months now. When Indian exporters receive money from foreign buyers, they must bring that money back to India within a specified time period. Now exporters have more time to do so. This helps businesses manage cash flow better, especially when global trade conditions are uncertain. If you look at all the 4 major announcements together, a clear pattern emerges. RBI wants more foreign capital inflows, stronger demand for Indian financial assets, stable foreign exchange reserves, support for the Indian rupee, and greater resilience against global shocks. So the key takeaway from this MPC meeting is simple. Interest rates remain unchanged. No tax for foreign institutional investors who are investing into government bonds. Inflation risks are still being watched carefully, and economic growth overall remains strong. The governor's message is very clear. Stay cautious on inflation, stay confident on growth, and keep India's financial foundation strong.